and welcome to this session on bonds. In this session, you will learn all about bonds, features of bonds, reasons for investing in bonds, and types of bonds. Let's get started. But first, a question. Have you ever borrowed money? Of course you have. Whether we beg for money from our parents, to buy a candy as a children, or ask a bank for a mortgage, most of us have borrowed money at some points in our lives. Just as people need money, so do companies and governments. A company needs funds to expand into new markets, while government need money for everything from infrastructure to social programs, everything. The problem large organizations run into is that they typically need far more money than the average bank can provide. The solution is to raise money by issuing bonds or other fixed income instruments to the public market. Thousands of investors then each lend a portion of the capital needed. Really, a bond is nothing more than a loan for which you are a lender. The organization that sells a bond is known as an issuer. You can think of bond as an IOU given by a borrower, the issuer, to a lender, investor. Bonds are debt instruments issued for a period of normally more than a year with purpose of raising capital by borrowing. Bonds are known as fixed income securities because you know the exact amount of cash you will get back if you hold the security until maturity. They are tradable instruments that represent a debt owned by issuer to the owner. Let us see what a bonds look like. Shown on the screen is a sample bond certificate. This bond certificate is from Mansfield and Framingham Railroad Co. Is it complete with a coupon in a lower left column. Note that the face value of the bond is printed in pink, written also in the graphic in the upper left of the picture. This particular bond has been cancelled as is evidenced by the cancellation holes over the signatures of the president and secretary, lower right, and the cancel stamp in two locations. In the upper right, you can see that the bond is number 26. Finally, note the ornate artwork which is intended to discourage counterfeiting. Depending on the duration, a bond can be classified as short-term bonds which are up to 5 years. Next are medium-term bonds which can be between 5 and 15 years. And lastly, long-term bonds which are over 15 years. Bonds, while a more conservative investment than stocks, can offer certain investors some very attractive features. The first reason for investing in bonds that they carry a higher interest rate in case unsecured bonds, which will be discussed later. Secondly, in case of government bonds, they are tax exempted and thereby guarantee returns. Next is instruments like bond are very liquid and can be easily converted to cash. And lastly, investing in bonds is safer than other investments like stocks and shares because of the fixed return guaranteed. Process of bond issuance is more or less similar to that of equity. To begin the process of issuing corporate bonds, the company has to select an underwriter who will help in determining the specifics of the bond, including when the bonds will be matured, the interest rate offered, and various other conditions. Then it is necessary to submit the legal documents to a regulatory body like SEBI. Next, the pricing of the bond is done once preliminary orders for the bonds have been accepted. The company will then submit the final pricing to the governing body. In the US, for better transparency of bond trading, they have trade reporting and compliance engine, TRACE, which is an underwriter and part of National Association of Security Dealers. It is duty to get the bond issuance approved with concerned depository and clearing authorities. In the US, it is DTCC. Once the issuance is approved, marketing of bonds issuance can be kick-started. The issuance in corporate bonds can be done upon receipts of funds, deposit amounts from investors. Did you know the total market value of world's bond markets are about 50% larger than world's equity market? Most issues are denominated in US dollars, euro and Japanese yen. The US bond market depth, generally referred to as the bond market, exceeds $35 trillion, making it by far the largest securities marketplace in the world. Here we can take a look at issuance of bond in Indian context. Some of the large corporations that have issued bonds are L&T Finance Holdings, Muthoot Finance, National Highways Authority of India and the Indian Railway Finance Corporation. Please note, a company can issue bonds again and again, and each bond can have different maturity periods, interest rates and terms and conditions. There are several types of bond. Let us begin with issuers. Issuers bonds can be categorized based on issuing authority, under which we have government bonds, corporate bonds and municipal bonds. Bonds can also be classified based on collateral, that is security. These bonds include secured and unsecured bonds. Next we have maturity, under which we have zero coupon bonds, perpetual bonds, deferred bonds, callable bonds and puttable bonds. Finally we have other type of bonds, which include convertible bonds, foreign exchange bonds, inflation index bonds and junk bonds. We will take a closer look at these bonds in the next few minutes. Let us first begin with the first category of bonds based on issuers. Let's begin with government bonds. A government bond is a bond issued by a national government, generally with the promise to pay periodic interest payments and to repay the face value on maturity date. They are also known as sovereign bonds. For example, the US government is far more secure than any other corporation. Its default risk, the chance of debt not being paid back, is so small that US government security are known as risk-free assets. Government bonds can be known by many names depending on which government issues them. For instance, UK bonds are known as gilts, German bonds are known as bunds, US bonds are classified as T-bills, T-notes and T-bonds, while Indian bonds are known as G-secs. Coming to corporate bonds. A corporate bond is a bond issued by a corporation. Corporation issue these bonds to raise money effectively in order to expand its business. The term is usually applied to a longer term debt instrument, generally with maturity debt falling at least a year after their issue date. Corporate bonds are often listed on major exchanges and ECNs. The coupon, that is interest payment, is usually taxable. Next we will learn about the issuance of corporate bonds. Corporate bonds can be issued in two ways. In a public issue, the corporation issue bonds to the market as whole. Institutions as well as retail investors can participate in this issue. The cost of borrowing is on higher side in case of public issue. In a private placement, corporation generally park the bond issuance with few institutions. In India, more than 90% of the corporate bonds are issued through private placement. It is the easiest and the cheapest way of borrowing corporate bonds. Moving on to municipal bonds. A municipal bond is a debt security issued by a state, municipality or county to finance its capital expenditure. If your primary investing objective objective is to preserve your capital while generating a tax-free income stream, municipal bonds are worth considering. Municipal bonds are also known as munis. When you buy a municipal bond, you are giving a loan to the issuer in exchange for a set number of interest payments over a predetermined period. At the end of that period, the bond reaches its maturity date and the full amount of your original investment is returned to you. They are exempt from federal taxes and from most state and local taxes, especially if you live in a state which the bond is issued. Municipal bonds may be used to fund expenditures such as construction of highways, bridges or schools. Munis are bought for favorable tax implication and are popular with people in high income tax brackets. Let's move on to the next category of bonds based on collaterals. Let us start with secured bonds. Secured bonds are a type of bond that is secured by an issuer. Secured bonds are a type of bond that is secured by the issuer's pledge of a specific asset, which is a form of collateral on the loan. In event of a default, the bond issuer passes the title of the asset or the money that has been set aside onto the bondholders. Secured bonds can also be secured with a revenue stream that comes from the project that bond issue was used to finance. Because of the pledge of an asset, secured bonds are seen as less risky than unsecured bonds, and they generally provide lower returns than unsecured bonds. Securing a bond with the pledge of an asset is also a way for the bond issuer to lower its interest payments. Moving on to the unsecured bonds. They are bonds that are not secured by specific assets, but rather the full faith and credit of the issuer as referred as unsecured bonds. In other words, the investor has only the issuer's promise to repay, but no claim on specific collateral. The fact that unsecured bonds do not provide holders with a claim on the assets of issuing firm in the event of default is normally compensated for by means of high rate of coupon payment. Let us continue with types of bond based on their maturity periods. First, we have zero coupon bonds. A zero coupon bond is a bond bought at a lower price. It is issued at a discount with the face value repaid at the time of maturity. That is, it is redeemed at par. It does not make periodic interest payments or so-called coupons, hence the term zero coupon bond. When the bond reaches maturity, its investor receives its par or face value. The difference between purchase and redemption is the coupon amount. Coming to perpetual bond. A perpetual bond is a bond with no maturity date. With perpetual bonds, the agreed upon period over which interest will be paid is forever, as perpetual bonds live up to their name and pay interest in perpetuity. In this respect, perpetual bonds function much like dividend-paying stocks or certain preferred securities. Just as the owner of stock receives a dividend payment as long as stock is held, the perpetual bond owner receives an interest payment as long as the bond is held. Perpetual bonds have a long history. The British government is often credited with creating the first one way back in the 18th century. They were called as consol. Perpetual bonds are of interest to investors because they offer steady, predictable sources of income. A variety of risks are associated with perpetual bonds. Perhaps the most notable is that a perpetual period is a long time to carry on credit risk. As time passes, bond issuers, including both government and corporation, can get into financial trouble and even fail. Another significant risk associated with the time is that general interest rates may arise as the year passes. If rates rise significantly, the interest rate paid by a perpetual bond must be lower than prevailing interest rate. meaning investors could earn more money by holding a different bond. In such a scenario, the perpetual bond would need to be sold on the open market, at which time it may be worth less than the purchase price as investors discount their offers based on interest differential. Moving on to the deferred bonds. Deferred bonds are debt instrument that pays interest only upon maturity. Let's take an example. ABC Car Wash offers to issue deferred bonds at 6% on $500 for 1 year. So, they have to pay interest on only the date of maturity, that is the end of the year. Unlike most bonds, a deferred interest bond does not make periodic or coupon payments over its lifetime. Instead, the interest accrues and it paid out when the bond expires or matures. A deferred interest bond can be a good choice for those looking to save money while accruing more interest than they might receive in a bank savings account or money market fund. Coming to callable bonds. A callable bond is a bond that can be redeemed by the issuer prior to its maturity. Usually, a premium is paid to the bond owner when the bond is called. These are also known as redeemable bonds. The example shown on screen explains callable bonds. Here the issuer, that is the clothing company, has the right but no obligation to redeem the bond. Callable bonds can be redeemed or called prior to its maturity. The premium is paid to the bondholder when the bond is called. The main cause of a call is a decline in interest rate. Callable bonds protect companies in event that interest rates drop. If interest rates have declined since the company first issued the bond, it will likely want to refinance this debt at a lower rate of interest. Moving ahead, we now see puttable bonds. Puttable bond is a bond with an embedded put option. They are known by many names such as put bond, puttable, or retractable bonds. The holder of a puttable bond has the right but not the obligation to demand early repayment of the principal. The example shown on the screen explains puttable bonds. Here the investor who holds the bond can force the issuer to repurchase the bond. This type of bond protects investors. If interest rates rise after the bond purchase, the future value of coupon payments will become less valuable. Therefore, investors sell bond back to the issuer and may lend proceeds elsewhere at a high rate. Bondholders are ready to pay for such protection by accepting a lower yield relative to that of a straight bond. The investors cannot sell back bond at any time, but at specified dates. However, they would still be ahead of holders of non-puttable bonds who may have no more right than timely payment of interest and principal, which could perhaps be many years to get all their money back. The price behavior of puttable bond is the opposite that of a callable bond. Since call option and put option are not mutually exclusive, a bond may have both options embedded. The formula to calculate puttable bond is as follows. Price of a puttable bond is equal to price of a straight bond plus price of a put option. Price of a puttable bonds is always higher than the price of a straight bond because the put option adds value to an investor. The yield on a puttable bond is lower than the yield on a straight bond. Lastly, we move on to other types of bonds. To begin with, we have convertible bonds. A convertible bond is one that can be converted into a predetermined amount of its company equity at certain time during its lifetime, usually at the discretion of bondholder. How do convertible bonds work? Let's take an example. Suppose XYZ supermarket, which is publicly listed company, wants to raise funds through medium of bonds. It can offer convertible bonds to its investor. Later, at pre-decided date, these convertible bonds can be converted to equity at an already agreed date while issuing these bonds. Convertibles are sometimes called as CDs. Issuing convertible bond is one way for a company to minimize negative investor interpretation of its corporate actions. From investors' perspective, perspective, a convertible bond has a value-added component built into it. It is essentially a bond with a stock option hidden inside. Thus, it tends to offer a lower rate of return in exchange for the value of the option to trade the bond into stock. Next, we come to inflation indexed bonds. An inflation indexed bond is a security that guarantees higher return than the rate of inflation if it is held to maturity. Inflation indexed securities link their capital appreciation or coupon payments to inflation rates. Daily inflation index bonds pay a periodic coupon that is equal to the product of daily inflation index and the nominal coupon rate. The first known inflation index bond was issued by Massachusetts Bay Company in 1780. The market has grown dramatically since the British government began issuing inflation-linked gilts in 1981. As of 2008, government issued inflation-linked bonds comprise over $1.5 trillion of international debt market. Moving ahead, we have foreign currency bonds. A foreign currency bond is a type of convertible bond issued in a currency different than issuer's domestic currency. In other words, the money being raised by issuing company is the form of a foreign currency. Foreign currency bonds are bonds which are issued by governments, companies and large corporate entities in a foreign country to raise capital. These are issued to take advantage of interest rate difference between countries. Bonds issued in US by non-US issuers are known as guarantees. Bonds issued in UK by non-UK issuers are known as bulldogs. Bonds issued in Japan by non-Japanese issuers are known as samurai. Lastly, we come to junk bonds. Junk bonds is a colloquial term for high yield or non-investment grade bond. Junk bonds are fixed income instruments that carry a rating of BB or lower by Standard & Poor's or BA or below by Moody's. Junk bonds are so called because of their higher default risk in relation to investment grade bonds. Let's take an example of junk bonds. Let's say ABC Baker, which has BB credit rating, is looking to raise funds. Market value of bonds offer 8% coupon rate. So ABC Bakers offer bonds at 12% coupon since their credit rating is low. Now the investors find potential in their business and are ready to take a risk in spite of their poor rating. So they invest into these junk bonds. Junk bonds are risky investments, but they have a speculative appeal because they offer much higher yields than safer bonds. Companies that issue junk bonds typically have less than stellar credit ratings, and investors demand these higher yields as compensation for the risk of investing in them. A junk bond issued from a company that manages to turn its performance around for better and has its credit rating upgraded will generally have a substantial price appreciation. Basically, junk bond works on the concept of high risk, high reward. With this, we reach the end of this session. We hope you understood bonds, its features and type with this session. Thank you and goodbye.